Welcome to our exploration of international finance, a fascinating field that connects economies worldwide. We'll be navigating the global flow of money, trade, and investment, understanding how capital moves across borders. Now, let's look at the core pillars of international finance, the fundamental components that support global financial systems. These pillars help us understand the mechanics of global money movement and how currencies interact internationally. First, we have the foreign exchange market, often called forex, where currency trading happens globally. This is the global marketplace where currencies are bought and sold around the clock. Exchange rates in this market fluctuate based on supply, demand, and various economic factors constantly. Participants include banks, financial institutions, and individuals trading major currency pairs daily. Next, let's examine exchange rates, which represent the value relationships between different currencies. An exchange rate shows the value of one currency expressed in terms of another currency. These rates can be either fixed, meaning pegged to another currency, or floating, meaning market-driven. They're influenced by factors like inflation, interest rates, and political stability in each country. Now, we'll explore the three exchange rate systems that countries use to manage their currency values. These systems represent different approaches to how countries manage their currency values internationally. The first system is the fixed exchange rate, where a currency's value is tied to another currency. In this system, the currency value is tied to another currency or a basket of currencies for stability. Countries use this approach to create stability and attract foreign investment with predictable rates. A good example is the Hong Kong dollar, which has been pegged to the US dollar for decades. The second system is the floating exchange rate, where market forces determine currency values. Here, the value is determined purely by market forces of supply and demand in the global market. These rates fluctuate continuously throughout trading days based on market conditions. Major examples include the US dollar and the euro, which float freely in international markets. The third system is the managed float, which combines market forces with central bank intervention. This system is market-driven, but allows for central bank intervention when necessary for stability. Central banks stabilize the currency if it deviates too far from a desired target range. The Indian rupee, managed by the Reserve Bank of India, is a good example of this approach. Let's examine the key drivers of currency value that influence exchange rate movements globally. Understanding what makes exchange rates move helps us predict currency movements more accurately. The first key driver is inflation, which significantly impacts currency purchasing power. Generally, lower inflation rates often strengthen a currency by maintaining its purchasing power. Next, interest rates play a crucial role in attracting international capital flows. Higher interest rates typically attract foreign capital, which boosts the currency's value significantly. Political stability is another critical factor that investors consider when evaluating currencies. Stable political environments generally lead to stronger currencies as they reduce investment risk. Finally, economic indicators provide ongoing signals about a currency's fundamental strength. GDP growth, employment rates, and trade balance all play important roles in currency valuation. Now let's discuss why currency exchange matters in enabling global economic activities and trade. Currency exchange is essential for enabling various global economic activities between nations. First, international trade relies heavily on currency conversion for cross-border transactions. Businesses must exchange local currency for foreign currency to pay for imports and exports regularly. This process is absolutely essential for facilitating smooth cross-border commercial transactions. Second, foreign investment requires currency conversion for global capital movement. Investors convert their local currency to foreign currency to purchase overseas assets and investments. This conversion process facilitates the global flow of capital across international markets. Third, hedging currency risk helps companies manage financial uncertainty in global operations. Companies use various financial instruments to protect against adverse exchange rate fluctuations. This hedging reduces financial uncertainty in international business deals and contracts. Finally, let's explore the three types of currency risks that businesses face in global markets. Understanding these risks is crucial for navigating financial uncertainties in international business. The first risk is exchange rate risk, which affects transaction costs over time. This involves fluctuations that affect transaction costs, particularly in long-term international agreements. Next, we have transaction risk, which occurs during the settlement process of deals. This risk arises from rate changes between when a transaction begins and when it settles. Finally, translation risk affects how companies report their international financial results. Currency shifts can significantly impact the value of foreign subsidiary financial statements when converted. Now, let's explore various strategies for hedging foreign exchange risk to protect your international investments. These methods are specifically designed to protect your business against unpredictable currency volatility in global markets. First, we have forward contracts, which are among the most common hedging instruments available. With forward contracts, you can lock in a specific exchange rate today for a future transaction date. Next, let's consider currency futures, which offer another approach to managing exchange rate risk. Currency futures are standardized contracts that are traded on organized exchanges with set settlement dates. Another important tool is currency swaps, which provide more flexibility in risk management. Currency swaps allow you to exchange currencies now and then reverse the transaction at a later agreed-upon date. Finally, we have options contracts, which offer a different kind of protection mechanism. Options give you the right, but not the obligation, to buy or sell currency at a predetermined exchange rate. Let's dive deeper into currency options and understand the difference between call and put options. These financial instruments provide specific rights to either buy or sell foreign currency at set prices. First, we'll examine call options, which are particularly useful for certain hedging scenarios. A call option gives the holder the right to purchase currency at a predetermined strike price. This type of option protects you when you're concerned about foreign currency appreciation increasing your costs. For example, a U.S. company might buy a call option on euros to lock in a favorable exchange rate. Now, let's look at put options, which serve a different protective function in currency hedging. A put option provides the right to sell currency at a specific predetermined strike price. This option protects against foreign currency depreciation that could reduce your revenue. For instance, a European exporter might buy a put option on US dollars to secure their exchange rate. Now, let's discuss letters of credit, which serve as crucial payment guarantees in international trade. A letter of credit is a bank-issued document that guarantees payment to sellers when buyers meet all specified terms, providing high security and building trust between unfamiliar trading partners, while mitigating risks like non-payment through complex but vital mechanisms for secure cross-border transactions. Next, we'll examine SWIFT, the global financial messaging system that facilitates international banking. SWIFT is a secure worldwide network that enables banks to exchange financial transaction information using standardized instructions and unique bank identification codes to ensure fast, secure communication for cross-border payments without actually transferring funds directly through their system. Now let's explore the 5 primary methods of transfer pricing used by multinational corporations. These methods help ensure fair profit allocation across international borders for tax compliance. The first method is comparable uncontrolled price, often referred to as CUP. This approach compares prices of similar transactions between completely independent business parties. Next is the resale price method, which takes a different approach to pricing determination. This method calculates appropriate prices based on resale prices to independent customers minus a reasonable margin. The third approach is the cost-plus method, which builds pricing from production costs. This method adds a standard markup percentage to the actual costs incurred by the selling subsidiary. Then we have the profit split method, which takes a collaborative approach to profit allocation. This method distributes profits based on each entity's relative contribution to the overall transaction. Finally, the transactional net margin method, known as TNMM, uses profit comparisons. TNMM compares the net profit margin of controlled entities to those of independent comparable companies. Let's summarize the key concepts we've covered in our international finance discussion. Here are the essential takeaways for developing a solid understanding of global finance. First, international finance governs all financial transactions that cross national borders. Forex markets facilitate currency exchange, which is absolutely crucial for global trade and investment. Exchange rates are influenced by various economic factors and political stability in different countries. Businesses manage currency risks using hedging strategies like forwards, futures, and options contracts. Letters of credit and SWIFT systems ensure secure international payments between trading partners. Finally, global taxation and transfer pricing are vital for multinational compliance and operations.